board Mr. Rajnish Kumar, former chairman of SBI, to talk about markets, how life has changed for him in his new avatar, and what his future plans are, and more importantly, where does he see that PSU banks are now headed, given that in the recent round of QIP, all of them have got a success. Mr. Kumar, good morning. Fantastic to have you back on ET Now. When we spoke to you last, you said that once you step down from being the chairman of SBI, you would like to start your morning in a much more relaxed manner, with a morning cup of chai, a newspaper, and perhaps watching ET Now. So I hope you made those changes and your day starts with chai, khabar, and ET Now.
Yes, absolutely, and in the sunshine of Gurgaon.
But how you been, sir? It's so good to connect with you. How's life changed in last couple of weeks for you?
So definitely much more relaxed, but at the same time, because I was relocating from Mumbai, and it takes its own time for relocation. And so most of the time has gone into planning for the location and actually relocating it. And last week, I relocated to NCR.
Well, okay. Glad, sir. I would like to draw your attention to the latest round of fundraising PSUs have done. SBI, like you promised, does not need capital, and SBI has not raised capital, but the other banks have raised capital. In your assessment, do you think this is growth capital, or banks are shoring up their balance sheet because they need to provide for COVID losses which they have not provided for?
One is definitely that all banks and public sector banks included, so they have made, I would say, adequate provisions, and particularly for the legacy account. And COVID-19 provisions is still the story which is turning out to be is not as gloomy as it was predicted to be. So the capital which banks are raising, partly it may still be needed for further strengthening provision coverage ratio or keeping it as a risk capital. But otherwise, the capital which the banks are now raising, it should be used for growth in their balance sheet.
Do you see, or do you genuinely see that a new capex cycle and a new credit cycle could start? Because when India's biggest cement company Ultratech or biggest company Hindalco, when these companies talk about adding capex, it just tells you that things are bouncing back. Do you think for corporate India, next 12 months, next 18 months could be dramatically different, and banks also will enjoy the premium of a new credit cycle?
The environment for investment in India, I think it is very favorable as of now. We have a very favorable tax regime. The demand has more or less come back, and the capacity utilization in most of the industries has improved. Coupled with the expenditure which can happen on building up the infrastructure, for which we have a very robust pipeline. So all this points to to a scenario where the investment cycle in India can come back. And of course, there is always a time lag. Any project which is planned, and then when it comes to the execution stage and the time when the credit gets utilized, so there is a time lag of 12 to 18 months. But in the meantime, I'm sure that we will have more clarity around this scenario which is emerging out of COVID-19. And this is the time that banks should themselves get ready, that when the demand for the credit, particularly from the corporate credit and for the capex, comes back, then they are in a position to fund that demand and as well as grow their business.
Sure. Sir, now we've seen a huge fillip when it comes to the rural side, the agri and SME theme playing out. Leading PSU banks, of course, have a huge exposure here. What are the kind of opportunities you foresee? Is this a trend that can really become, a bigger play going forward?
You're talking about the rural demand?
Yes.
Yeah, no, definitely. And in this COVID-19 situation also, we have seen that it is the rural economy which has kept the wheel of the economy going on. And luckily for the country, the crops were good. And the impact of the COVID, at least in the initial phases, was much less. And for a country of 1.38 billion people, 138 crore people, the demand has to come from all segments. But the expenditure trend which is being seen, and even if it is the statistics related to e-commerce company, tier 2, tier 3 cities have performed well as far as demand is concerned. The COVID-19 impact was more pronounced in respect of the cities. And cities were more impacted. And there are still certain sectors where demand is yet to pick up, particularly your aviation sector, your hospitality sector, your luxury spend. So these are some of the sectors where still there would be some time left. But most of the other segments of the economy, they are doing well. And the numbers have been, I would say, encouraging. Whatever numbers have come for IIP or the other indicators of the economy. And rural and semi-urban centers are going to play an important role. And the banks also are now focused, and it's not about private or public. All banks, they have a very definite plan to tap the rural and semi-urban markets.
Okay. How do PSU banks protect their deposit franchise, from larger private peers? How can they really strategize and come up with ways in order to do that?
Well, I think on deposit front now, most of the banks are doing well. And the numbers of the State Bank of India, which came out, it also showed that the growth of deposits, particularly for State Bank of India, is higher than any other player. And public sector banks' deposit franchise has by and large remained intact. But ultimately, the faith of the people, it is more as far as their deposits are concerned. It is, again, the quality of the service and the level of digitization. These two would be the determining factor. And per se, because people believe that government ownership makes their money safe when it comes to the public sector banks. So that is an advantage as far as public sector banks are concerned. Second is their reach across the country. They are much more, they have a much more robust distribution network of branches as well as business correspondents. So there are certain advantages which public sector banks have. But when it comes to the, say, high net worth individuals, the quality of the service is where improvement is required. And improvement in service can come apart from the people who man the branches. But apart from that, technology is going to play a very significant role. And the banks who are underinvested in technology, they may lag behind and may not be able to compete in the market.
Mr. Kumar, we've seen the challenge what technology could impose, and the fact that HDFC Bank platform had digital issues. Even in a sense, had some digital issues. Do you think now banks, they really need to invest a lot in technology, and that's not because of anything else, but because of COVID, the digital transactions have become multiple. I mean, there has been a 5 to 10x jump in some digital transactions is what I understand. So do you think now that should be the focus area for most of the banks to update and upgrade their technology and systems?
Yes, capability to handle the volumes and scale. And definitely there has been an explosion in the number of transactions which are happening on UPI platform and other digital channels. And that itself brings a challenge. And with the technology, the biggest challenge is around what we have seen, that keeping the systems up and running 24/7. Second is, of course, the cyber security and data security. So these are some of the challenges, but this trend of adoption of technology everywhere, it is an irreversible trend. And yes, this would require substantial investment in technology and periodic upgradations. And that is what I'm sure banks are aware. And they will be taking steps to correct the situation and whatever has happened. The warning from the regulators, and it is for all the banks, not HDFC Bank alone. It is for all the banks that they have to keep their systems robust, up and running, and take as many measures as required to keep the customer data protected. Identity theft is a big issue as far as the digital banking is concerned, and as well as the cyber security.
And before we wrap, Mr. Kumar, what are your thoughts on where fixed deposit rates are headed? From a SBI fixed deposit rate, which was at 8% plus couple of years ago, now numbers have come down to 5 to 5.5%, looking at the different bracket. Do you think fixed deposit rates in India, have they bottomed out, or they could remain low and could go down further?
So it's all a function of also that when we take deposits, we have to deploy it or lend in the market. So lending rates are also at a historic low. And there is an excess liquidity in the system. Till such time that excess liquidity is sucked out of the system, the deposit rates cannot go up. But at the same time, all the pointers are that the rate seems to have bottomed out. And they may not go down further. And if at all, like depending upon how the inflation numbers as well as the growth numbers for the economy turn out to be, then whatever pointers come from Reserve Bank of India and their monetary policy, depending upon that, banks will have to calibrate their response. But right now, all banks are flush with funds. And in such a scenario, interest rates on deposits will remain subdued as they are currently.
All right, we'll leave it there. Thanks so much for joining us this morning, Mr. Kumar. Always good talking to you.
Thank you.
And getting some critical insight there on the major theme that the markets are focusing on. Let's take a very quick break. We'll be back on the other side.